We know that many clients, especially senior clients, place a great deal of trust in the person that is advising them. Therefore, finding the right advisor to work with is really critical. And one of the tools that one can use is IIROC's online advisor check database. They can visit us at www.iiroc.ca and visit the advisor report section. That section will be able to tell investors whether the person they're working with is regulated by IIROC, whether they've ever been disciplined, and whether there are any restrictions that are placed on them. So we do encourage investors, and we also encourage the industry to visit our online database.
It's a competitive market. There are many advisors that will be more than happy to help clients manage their money and their investments. It is important that the client, and especially the senior client, is comfortable with the advisor that he or she is dealing with. If it's at the beginning of a relationship, I would recommend interviewing a few different advisors at different firms. Interview advisors, see who is providing the best value and is the best fit for you. If you are at a firm and you would like to remain at that firm but are not happy or have questions about the advisor, all IIROC member firms and all IIROC member clients of those firms receive client statements, and the branch manager's name is on that statement. Contact the branch manager and just have a conversation. It can be that the first advisor is a very good advisor, but is not a good match. And the manager can recommend someone else in the branch that may be more suited.
I would certainly encourage seniors to create a plan, because once they have a plan, that will give them confidence and will give them comfort towards achieving their financial goals. Now, there's always a little bit of anxiety to the steps that precede, creating a plan. So they need to really take stock of their financial situation, need to understand, again, those government benefits and entitlement to government benefits. They need to determine how much money they'll need as well in their retirement to, whether it is to maintain their standard of living or simply their desired standard of living, and then craft a plan around that. And if they're having difficulty putting a plan together, I would really urge them to get some professional assistance in putting a plan together. But there are two things that I would encourage seniors to do. The first is to establish a budget. We know from our Canadian Capabilities Survey that only 50% of us actually have a budget. But that 50% that does have a budget tends to stick to it. So it's very important to have a budget. The other tip I would have would be to be wary of debt. The average debt of seniors has actually doubled in the last 25 years, and 1 in 5 seniors still have a mortgage and still has a credit card balance. So it seems that seniors are getting increasingly comfortable with that debt. That could be a bit of a trap when you're beyond your earning years. And so we would encourage seniors to invest in themselves and pay down that debt as an investment.
Well, the risk versus return discussion generally comes up quite commonly in situations where a senior has multiple investment objectives and there's a potential that they won't be able to achieve all of them. As a specific example, investment objectives where the client wants to maintain capital preservation as well as income generation as 2 investment objectives. And in some situations, the only way the client can achieve both of those investment objectives is by assuming greater risk in their investment portfolio. I think the key in those discussions that take place between the advisor and the client is discussing with the client their comfort level with risk, the amount of risk that they're willing to assume, and specifically their ability to absorb losses should they occur in a particular investment portfolio. That conversation of risk should yield a conclusion in terms of the client being comfortable with a certain level of risk. And based on that level of risk they're willing to assume, there may, in turn, be those difficult discussions in terms of, well, you're an investor that has a low tolerance for risk. You need to accept that there may be some decline in your capital levels over time because dipping into your nest egg is going to be the most practical way of meeting your investment objectives and maintaining adequate income. So those conversations, it all goes back to effective communication. Those conversations should take place early and often during the account as it's being built up over time, but more particularly as the client retires, those regular conversations need to take place.
I think for investors, what's important is that it's a two-way street. It is important that there be effective communication with the advisor. If there are life events that take place, it is important that the advisor be aware of that. Investors have a lot of power. If they are not happy with their advisor, then they should change their advisor.
Investors should feel that they're an equal partner in the account relationship, and in instances, particularly if they're dissatisfied with the advice they're receiving or their service levels they're receiving, they should have no hesitation in having those candid discussions with their advisor about their discomfort in the advice they're receiving or maybe the service levels they're receiving, in order to ensure that either the relationship changes to their satisfaction or to enable them to make a decision as to explore other options.
I would offer 3 steps consumers can take to protect themselves. The first one is that they should be protecting their PIN when they use their debit and credit card. They shouldn't be sharing their PIN with their spouse, their kids, friends, because if they do share it, then they jeopardize the coverage they have for zero liability for those cards. So we urge them not to share their PINs. The second step would be to check their bank account records, their credit card statements to make sure that they are accurate and there are no errors. If they happen to find an anomaly, they should contact their financial institution. And the third step I would urge seniors to follow is not to provide any personal or financial information on the phone or on the computer, on a website, or online.